Assets and funds under management, maximizing investments through effective management strategies. Presentation overview. Assets under management. Assets under management, AUM, refers to the total market value of assets managed by an investment firm on behalf of clients. This includes stocks, bonds, real estate, and other types of assets. Funds under management. Funds under management is a subset of AUM and refers specifically to the market value of funds managed by an investment firm. Classification and types of AUM. AUM can be classified in different ways, such as by asset class, geography, or type of investor. This classification can provide insights into the size and scope of AUM across different institutions and wealth managers. Other types of assets that fall under management include alternative investments, private equity, and real estate investment trusts, REITs. These assets can be classified or grouped based on various factors such as risk, return, and liquidity. Overview. AUM and FUM are key metrics used to measure the size and growth of financial institutions. These terms refer to the total market value of assets that a financial institution manages on behalf of clients. Assets under management, AUM. Definition of AUM. Assets under management is the total market value of assets that a financial institution manages on behalf of clients, including mutual funds, hedge funds, pension funds, and more. Geographic segmentation of AUM. AUM can be divided by geography, such as global or regional asset management. This segmentation provides insights into distribution of assets and helps financial institutions to tailor their investment strategies accordingly. Asset class segmentation of AUM. AUM can also be divided by asset class, such as equities, fixed income, alternatives, and cash. This segmentation provides insights into the distribution of assets across different asset classes and helps financial institutions to tailor their investment strategies accordingly. Funds under management, FUM. Funds under management, FUM, refers to total market value of funds that a financial institution manages on behalf of clients. Examples of funds include exchange-traded funds, ETFs, private equity funds, and more. FUM by strategy. FUM can be divided by strategy, such as growth or value, to help investors better understand how their money is being invested. FUM by asset class. FUM can also be divided by asset class, such as equities or fixed income, to help investors understand how their money is being allocated across different types of investments. Other types of assets under management. In addition to AUM and FUM, specialized investment managers are often tasked with managing other assets, such as real estate, infrastructure, and private debt, which can offer unique investment opportunities. Classification and grouping of assets under management. Management style. Assets can be classified by management style, such as passive and active management. Understanding the pros and cons of each style can help investors make informed decisions. Asset class. Assets can be classified based on their asset class, such as equity and fixed income. Understanding how asset classes perform under different market conditions can help investors strategize their investment portfolio. Risk versus return. Assets can be grouped based on their risk versus return profile. Understanding the relationship between risk and return can help investors make informed decisions. Understanding assets under management. Importance of AUM. AUM is an important metric used to assess the performance and scale of financial institutions and wealth managers. It is used to determine the size of a firm's client base and the effectiveness of its investment strategies. Growth of AUM. The growth of AUM is an important indicator of the success of a financial institution or wealth manager. It reflects the ability of the institution to attract and retain clients and effectively manage their assets. Importance. Performance evaluation. AUM is a key metric used to evaluate the performance and scale of financial institutions and wealth managers. The higher the AUM, the better the performance and the greater the scalability. Revenue generation. AUM is a crucial factor in revenue generation for financial institutions and wealth managers. The more assets under management, the more revenue they can generate. Fee determination. AUM is also a crucial factor in determining the fees that financial institutions and wealth managers can charge. The higher the AUM, the higher the fees they can charge. Growth and trends. The growth of AUM is due to a combination of factors, including the growth of the global economy, increase in personal wealth, and emergence of new investment products and services. Assets under management have experienced significant growth over time, and this trend is expected to continue in the future. Classifying assets under management. Institutional classification of AUM. AUM can be classified by institution types, such as banks, insurance companies, and other financial intermediaries. This classification can help us understand how different institutions manage and invest their assets. Wealth manager classification of AUM. AUM can also be classified by wealth manager types, such as private banks, family offices, and independent advisors. This classification can help us understand how different types of wealth managers manage and invest their clients' assets. Classified by institution type. Banks. Banks are financial institutions that manage AUM by providing banking services such as deposits and loans. They also offer investment services such as wealth management and retirement planning. Insurance companies. Insurance companies are financial institutions that manage AUM by providing insurance policies. They also offer investment services such as annuities and mutual funds. Asset management firms. Asset management firms are financial institutions that manage AUM by investing in financial assets such as stocks, bonds, and real estate. They offer investment services such as mutual funds, hedge funds, and private equity. Classified by wealth manager type. Private banks. Private banks are financial institutions that manage the assets of high net worth individuals and families. They offer personalized service and investment products to meet the unique needs of their clients. Family offices. Family offices are private wealth management firms that manage the assets of one or more wealthy families. They offer a range of services including investment management, financial planning, and tax and estate planning. Independent financial advisors. Independent financial advisors are professional financial planners who work independently of any financial institution. They provide unbiased advice and investment management services to clients based on their financial goals and objectives. Conclusion. Assets under management. Assets under management is a metric used to measure the size and growth of financial institutions. AUM refers to the total market value of all assets that the financial institution manages on behalf of its clients. Funds under management. Funds under management is a metric used to measure the size and growth of financial institutions. FUM refers to total market value of all funds that the financial institution manages on behalf of its clients. Classification of assets under management. Assets under management can be classified into various categories such as equity, fixed income, real estate, infrastructure, and commodities. Understanding how assets are classified can help investors make informed investment decisions. Thank you.